rose to the top because of past success. And then TikTok came along and talk about disruption. And then a recession comes along, as exemplified by the advertising crash that is taking place and hurting many of these companies. And we're seeing layoffs and freezes, something we've never seen from these companies. But that's distinguished from the kind of innovation in our strategies. We are very early stage, and while our stocks may have suffered as much as the FANGs have, certain of the FANGs have, what we're seeing right now is very early stage growth. So we can talk about that in a little while. I just wanted to set that up. It has been one heck of a rough time for innovation of all kinds in the last 18 months. But if we are right, and of course we could be wrong, but if we're right, truly disruptive innovation is going to move into a growth trajectory that is to push back on excessive regulation. Regulation can be an innovation killer, so that will be good news. And we think there will be other innovation-friendly moves in terms of incentives and so forth. What's interesting about this election and this period in time is historically, and this is just history, this is, believe me, not at all partisan, it's just observing. Historically, the market has done better under Democratic administrations. And the conservatives would tell you, well, that's because we would have to come in and clean up all of the excesses, the excess spending, the excess monetary stimulus. And that would mean a crackdown on certain businesses, which would be bad for the market and bad for psychology. Seems like it's the opposite here. I have never seen fiscal outlays, federal outlays, down at a double-digit rate in the in a midterm election year or a national election year, and yet here we are, down year over year, and I have never seen monetary restraint, the likes of which we're seeing now, at a rate we have never seen historically. Never. We have never seen this. Many people equate what happened during Volcker's years as similar. Volcker was really trying to throttle inflation and raised interest rates from roughly 10% to roughly 20%. That's a twofold increase. With this week's action from the Fed, another 75 basis points, the Fed has taken interest rates up 16-fold in less than a year. Never been done before. And I think we're going to see the fallout during the next year. And when I say that, I mean it will be a cyclical fallout. And I think it will benefit those companies that can grow through this period. And as we said all during COVID, innovation solves problems. We have so many more problems now. Supply chains loosening up, but still we have the war in Ukraine. And now we have fiscal and monetary policy really tightening in a way that businesses are going to have to change the way they do things, increase productivity, cut costs, and so forth, in terms of huge discounts at Christmas. Even the Fed's own, that there are regional territories where the Fed engages with business leaders. There are 12 of them. Even these, I know they're not called territories, I think they're called banks, are showing in their monthly indicators. So the Empire Fed puts one out, the Philly Fed, Richmond, Kansas City, Dallas, And these are quantitative indicators. They may be subjective surveys, but they are subjective all the way along. And they are hitting the skids one by one, negative territory, negative. I looked through the last month's worth, and all of the banks that I just mentioned were showing increasingly negative sentiment about economic activity in their regions. And prices actually falling, and we did see that in the Purchasing Managers Index. Prices paid index showed negative prices, and again, we'll get into that in a minute. So money now, M2 growth peaked at 27% for that inflation to move to those levels. Now, it started in April and May of 1964, Vietnam War, Great Society programs, the Johnson administration putting into place many social programs at once. And it was a period called guns and butter, so spend on everything, which they did. So we had fiscal policy moving really out of control and monetary policy accommodating it. And also, as we went off the gold exchange standard in 1971, we closed the gold window. That was the last semblance of discipline in our monetary policy. That was 1971, as I said. You know, all hell broke loose. We had OPEC quadrupling oil prices. We had the Fed accommodating those oil prices, which eventually got into all kinds of indicators, including wages. And you'll often hear the expression cost push inflation. It comes from the 70s. The cost push was wages pushing through. And I think this time is very different. Then you had Volcker, as I mentioned, going from 10 to 20%. So twofold interest rates. And that did the job. This period is not 15 years, basically got rid of Miller, that Fed chairman, and brought in Chairman Volcker. And that was a terrific move. Now, the dollar in the early 80s started moving up dramatically, and it almost went parabolic and became a real problem for the world. Does that sound familiar? Here we are again. The dollar going up is a massive deflationary force. And it's deflationary because commodities are priced in dollars, the reserve currency. It's deflationary because emerging markets have a lot of dollar-denominated debt. Their currencies are falling apart, but they have to service their debt in dollars.